In this video, I'm going to share 5 things that most investors don't realize. We hear things in the media, we see the same things over and over and over. We also tend to think what has happened lately is going to keep happening, and that shapes what we think about investing. But these 5 things that most investors don't realize can have a crucial impact on you reaching your financial goals, on you getting the investment returns that you want. Okay, the very first thing that most investors simply don't realize is it doesn't matter if you're in an index fund or an ETF, for example. What matters most is you choose the asset class that you should be invested in. I'll get questions. What do you think about this particular fund? I never ever think the same thing about any particular fund. A fund can be, yes, there are things I look at, good or bad returns, the fees, etc. But that fund, I may feel completely different about it next year when that asset class is not a great asset class to be in. So it isn't the individual asset or security. It matters more about what asset class that you're in than the particular fund or a portfolio of stocks versus an index, etc. Okay, the second thing that most investors don't realize is it's not about picking the right stocks. The question is, what will stocks as a whole do? So a lot of people feel like, okay, well, I've got it figured out, I should be in stocks regarding the first thing I said. Okay, and then they think, okay, what stock should I pick and or should I buy a fund versus building a portfolio of individual stocks? The question is, what will stocks do as a whole? What will that asset class do as a whole? We can apply the same principle to bonds, we can apply it to real estate, we can apply it to the major asset classes, because the asset classes, the individual securities within that asset class tend to move with the overall asset class. Okay, the third thing that most investors don't realize is that annual returns matter much less than drawdowns. Okay, so I do it myself. I love to look at annual returns, and if you've seen my other videos, you know I say don't dare look at just a average, okay, 10-year average, annualized average on this fund, or 5-year annualized average is 8% or whatever. No. I want to see by year. I want to see every single year what that fund performance has been, or that product performance, or that manager's performance. I want to see what has it been by year. But and we love to categorize in our minds. We love time. It helps us feel more in control and safer when we categorize like that. I get it. But what we really need to do, and what I do when it comes down to it, is I look at drawdowns. What we want to see is how much did an asset that we're considering buying, whether that's a fund or a service or product, how much did it go down from that peak, that best level, to the lowest level? Because see, the return could go down mid-year and go down that year and then be down all the next year and then be down the first half of that third year. And so the returns don't look so bad. It looks like there was maybe one down year. But what we really want to do, and what happens in reality, is that we reach that high mark and we're like, great, wow, this fund I picked, or this manager I picked, or whatever product it is doing fantastic. And then we have the drawdown. The drawdown lasts the painful maybe 18, 24 months, 36 months sometimes. So what we really want to do is look at drawdowns, not just annual returns. Okay, the fourth thing that most investors don't realize is that this one is so big. The entire foundation of portfolios that are allocated among stocks and bonds, that modern portfolio theory, that whole deal, is built on a flawed principle. That's right. It's built on the principle that treasury bonds will go up when stocks go down. U.S. large cap stocks and long-term government bonds don't always move in opposite directions. Period. Bing, I said it. That's it. sometimes they're correlated. That means sometimes they move in the same direction. Investors are led to believe and they think that portfolios won't go down if they own both stocks and bonds. But this is just no longer true. It's not a reality. The fact is that stocks and bonds have been correlated or moved in the same direction more often than not throughout history. In 2022, the S&P 500 was down just over 18%, and the 20-year Treasury bonds were down 26%. Okay, so we saw this play out. I was talking about this before 2022 and getting lots of negative comments and arguments because people believed that stocks always are protected by bonds in a portfolio, but they're not. And we saw this play out in 2022 in a really big way. It wasn't just 2022. That wasn't an anomaly. From 1926 through 1999, stocks and bonds had a positive correlation, meaning they moved in the same direction, and that positive correlation was 0.18. And that's according to Alpha Architects data. But there's more. Stocks and bonds were positively correlated in three of the 9 years from 1969 through 1977. So just imagine if you had retired in 1968 with an asset allocation, you owned stocks and bonds, and you were thinking, oh boy, those bonds are going to keep me from losing money in my portfolio. Just imagine if you thought that. In 1969, stocks were down 8.5% and bonds were down just over 5%. Then again, in 1973, stocks were down almost 15% and bonds were down just a little bit, about 1%, a little over 1%. And then in 1977, stocks were down just over 7% and bonds were down 0.7%. So just a little bit. But still, they didn't save the investors. FS Investments wrote an article recently that the stock and bond correlation hit a multi-decade high, and that really concerns me. That's recently, that's this year. Let me repeat that. The stock and bond correlation hit a multi-year high. So this is likely to be a concern that we have going forward, and this is the whole premise behind the way that most people are invested, having that stock and bond allocation as a way to manage risk. How have I finally started addressing this after many decades of investing? Now I use a rotation strategy that rotates into stocks, bonds, and other asset classes as warranted based on technical analysis. I've done another video on that. If you want more information about that, be sure to leave a question in the comments. I'll try to remember to put that video in the comment section, definitely in the description section under the video or to the right of the video, depending on how you're watching it. Okay, the fifth thing that most investors don't realize is that many stock and bond yields are negative after inflation and fees, period. And certainly after taxes, we've got to throw those in as well. So we're going along thinking that we're getting this good return, this good yield, and again here I separate yield from capital gains because yield is a little more certain and capital gains is we may or may not get gains, we may or may not get profits in our securities. So those yields that are certain, those stated yields, they're often negative after we factor in inflation, fees, and taxes. And a lot of investors just don't realize it. Oh, it sounds great. I'm getting 5% or 4% from bonds now. Okay, but what about inflation of 3.5%? And what about taxes? Boom. Then that suddenly becomes a negative yield. Those are 5 things that most investors don't realize. But remember, retire certain with these things in mind.